Hello everyone. Welcome to another session of Revise S Pro from Uplift Pro. And in this particular session today, we would be covering certain parts of the section relating to financial statement analysis. That is section A, part 2. And as we have already said in some of our previous sessions also, this particular section is somewhere important for the exam because it has a weightage of 20%. So primarily in the financial statement analysis section today, we'll be covering some topics which are not much unknown to us, but these are important from an exam standpoint because often they may appear in the MCQs or that of a longer version of the question might be in the essay question. So here we are covering certain special issues like the book value, market value, accounting profit, and economic profit. So in this section, we would understand the concepts as a part of our revision and also try to solve a comprehensive problem that will cover all these concepts. So let us get started, everyone. So moving into quickly, what we have in store for the book value, market value, accounting and economic profit concept specifically, often these concepts are tested as a part of the MCQs, smaller questions where there may be the arcs of a meaning or there might be computation involved. Similarly, there might be a essay question under the financial statement analysis, which may have various subparts where they may be asked to compute the accounting profit or economic profit and then analyze and give a decision pertaining to the specific information in the problem. So if we need to remember certain important points around these concepts, what are the things that we need to keep in mind? Firstly, whenever we talk about the book value of an asset, it is normally the value at which the asset is recorded in the balance sheet. Say for a tangible asset, the book value is computed as the original cost less the accumulated depreciation. Similarly, when we spoke about the book value of a liability, it is normally the value at which the liability is recorded in the balance sheet. Say for example, a bond which is having a face value say equal to 100, if it is issued at a premium, then the book value would be somewhere the face value plus the premium. And if it is issued at a discount, then the book value will be the face value minus the discount. When we talk about market value of an asset, it is a value obtained generally by a sale of the asset from the market. When we talk about the market value of a liability, say bond, it is generally the value at which it is traded in the open market. So if the bond is traded at a premium, then naturally the market value will be greater than 100 when 100 is taken as a face value. And if your bond is traded at a discount, the market value will be less than that of 100. Now these concepts are not unknown to us. But as I have always said, that easy things become difficult under time pressure. So it's always good to revise and keep ourselves somewhere updated and refreshed with these concepts again. Coming into the next thing, that is basically the book value of a farm. How we compute it? It is basically the total assets minus the total liabilities and also the preferred stock that is being deducted from our total assets. So it's usually equal to the common shareholders' equity. Similarly, when we say about the book value per common share, it is book value divided by the common shares outstanding. Then finally, what is the market value of a share? It is the price at which the share is purchased or sold in the open market for a publicly traded company. So that is around the concept of book value of market value that should we keep in mind. Now moving into further the concept of accounting and economic profit. Now, what is accounting and economic profit? It is often heard by us, but there is a very finite difference between the two, which we should keep in mind. So, whenever we talk about accounting profit, that is in a general purpose financial reporting standards like GAAP based or IFRS based, the profit that is computed, that is basically our accounting profit. Now, then what is economic profit? So economic profit is something which takes into account the opportunity cost, what we call the basically the implicit cost, right? Which is really not taken into consideration as a part of our accounting profit computation. But remember, as the first point says, both accounting and economic profit are considered for determining the performance of an entity. That is, if you want to really judge the true performance of an entity, we have to consider the aspect of the implicit cost also, and we have to compute the economic profits also. Now, how do you get accounting profit? Very simple. Accounting revenue minus accounting expenses, and accounting expenses are like a explicit cost. Then economic profit, it also excludes the opportunity cost apart from the accounting expenses. And we say opportunity cost is the cost of the next best possible alternative foregone. Now, so how we are computing the economic profit is accounting revenue minus the accounting expenses minus the opportunity cost, that is the implicit cost. And one of the important aspects that we should keep in mind is that whenever the concept of economic profit comes into picture, as there is an alternative available and we are trying to determine the opportunity cost of the alternative, so naturally if the economic profit is positive, that means that we have chosen the right alternative. On the other hand, if the economic profit is computed as negative, that means the wrong selection of alternative has happened. So this might be a question that may be asked in our examination, that the economic profit has come as negative, what it basically infers, what you can interpret from that, right? So this is simple concepts that we should keep in mind. Let us now help us ourselves to understand how these concepts may be tested in an exam apart from a theoretical question if a numerical problem comes in. So basically what we'll try to do is that we'll try to solve a problem, right? And for that, just give me some time that I quickly refer to an Excel and help you out with that, right? Just let me share my Excel and we'll go ahead with it. Great. I think our Excel is visible. And if you see that I have brought a problem, and this is a simple problem, but a comprehensive one. And whenever you get such a problem in the exam, remember, this is more like a problem which may feature in the essay part. Because if it's an MCQ, then all the 4 parts may not come, as I have mentioned here. Might be 2 parts are asked or only 1 part is asked. So whatever be a MCQ or a essay question, it's very important to go around the call of the question, what's the question is asking for. And if we quickly skim through the information that is provided, it is providing a balance sheet with an extract of the assets and liabilities, where they have provided the assets including plant and machinery of $1 lakh with the original cost, accurate depreciation if you find 20,000, inventory and cash 50-30, and liabilities long-term debt 50,000. Then they have mentioned about the company's revenue to be 2 lakhs and its operating expenses excluding depreciation are 1 lakh 20, and the company follows a straight line method of depreciation and its remaining useful life is 5 years. And they have also given us the sale value of plant and machinery and the company's cost of capital as 10%. Now they have asked us 4 subparts. Now be careful that all these 4 subparts may feature as a part of your essay question, or it may feature as just one particular question in MCQ. So they have asked for computing the book value of plant and machinery, then the market value of the plant and machinery, the second question, and the accounting and the economic profit. So the ideal way to do this is that all the information that is here in the question is better to plot into a Excel as it is available as a part of our exam format. So if we quickly go to the solution tab, what I've done is that I've extracted the information and tried to use it for the purpose of solving the problem. So we know that the book value of plant and machinery is computed as the original cost minus the accurate depreciation. And if we quickly look into what we have done is that 1 lakh was the original cost and 20,000 was the accurate depreciation. So we are getting 80,000 as the book value. Then we come as a market value. Now, if you see that interestingly in this problem, directly the sell value of the plant and machine is $1,20,000 has been mentioned. So sometimes the solution is already given in the question and we have to be mindful in extracting that. They have not requiring us to compute, just to be careful in reading and get the response. So we get directly the response as 1,20,000, which is the sell value, which is taken as a market value. Now comes accounting profit. We know that accounting profit is basically our accounting revenue minus our accounting expenses, right? So how we are computing the accounting profit? We have got revenue of 2 lakhs from the question, operating expenses 1 lakh 20, depreciation we have computed as 1 lakh as original cost, 5 years left, straight line method. So 1 lakh divided by 5 gives us 20,000. And how do we get 60? Simple, from the revenue we are deducting our OPEX and depreciation to get our accounting profit, right? So that is the computation of third part. Now comes the economic profit. As we have understood that economic profit includes the accounting profit. From that we have to deduct the implicit cost or the opportunity cost. And what is the implicit cost out here? It is basically the cost of capital. Now, cost of capital here, be mindful that is not mentioning the interest payments or the obligations, and that is why it is not a part of our accounting expenses. Here, the cost of capital is basically the opportunity cost of using the capital for some other alternative. So here we are done is that the cost of capital mentioned is 10%. It is not an accounting expense, and we are applying the 10% on the total capital, that is the plant and machinery value plus the investments plus the cash plus the long term debt, which is coming as, and we are as 2 lakh 10, and with that we are applying the 10%. How do we get the 2 lakh 10? If you see the numbers, these are all obtained from the question, like 80,000 being the book value of plant and machinery, investments 50, cash 30, and 50 the long term debt. And when we apply the 10% on 2 lakh 10, we get 21,000, and 39,000 is obtained by deducting our 21,000. There is an implicit cost form basically our 60,000, which is basically the accounting profit that we have computed. So that gives us the 39,000 and the economic profit. Now the problem may just conclude here where it is computation part only, but interestingly there might be some interpretation arcs with these simple calculations, and so let us go ahead with the discussion points so that we are clear conceptually and can answer those if asked in our examination. So the first thing, if you notice that the book value of the plant and machinery is $80,000, which is lower than its market value of 1 lakh 20. This highlights the difference between the historical cost accounting and market value. Now here we are seeing that might be the asset is being sold at a higher value. That might be a situation. So it is a situation we are seeing that the historical cost and market value may not be the same always. Coming into the next point, that is the accounting profit is $60,000, which does not take into account the cost of capital because it's an implicit cost. As I've already mentioned, that cost of capital here is not the interest payments. So naturally, it's not an accounting expense. It is like an opportunity cost, implicit cost, not taken into consideration for the purpose of computing an accounting profit. Then comes the last point, which is very important. The economic profit is $39,000, which is lower than the accounting profit due to the cost of capital because we are deducting the opportunity cost out here. So this highlights the importance of considering the cost of capital when evaluating a company's performance. So a company's performance, to be truly evaluated, we also have to need to consider the opportunity cost. So here a positive economic profit suggests that the capital is properly utilized than the alternative opportunity to use the capital. As we have seen in our points in the PPT, that a positive economic profit indicates that basically the alternative which is being used has been right, but if it was negative, then the other alternative would have fetched better performance for the entity. So that's about a simple problem, how the calculation has to be done and how the interpretation can come. This area appears to be very simple, but my friend, as I've always said, is very important to be mindful in the exam center under the stressful environment to do the calculations properly and just do a double check to see that the simple thing we are not losing out of control, and this would be a fully high scoring area. So with that, we now go back to our PPT to see what is basically left us for us to discuss upon. So just give me a quick 1 minute that we move into. So we go back to our PPT. Yep. So we're back. So we have solved the problem. Hopefully the problem helped you to understand the concepts and clear your doubts. So this was all for our today's section. It's a short video helpful for you to just brush up again the concepts of book value, market value, as well as accounting and economic profit. I think with that, we are concluding our session for today. Hope this video will be helpful for you, and please look out for more such videos in the upcoming weeks as part of our Revise as Pro initiative from Uplift Pro. Thank you.